Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Marex, senior specialist with index research and development at Nasdaq Investment Intelligence, to discuss the Nasdaq U.S. Smart Oil and Gas Index, a highly relevant product given the geopolitical tensions and what's been happening across the energy space recently. Mark, it's great to see you as always. Welcome back to Trade Talks. And as we are speaking now at 2:33 on Tuesday, February 22nd, with President Biden announcing sanctions just now, certainly this index is going to be key and front and center. So give us a brief overview of what we're looking at here.
Yeah, sure, Jill. I mean, the relevancy, extends even beyond just the price of oil shooting up, which is an immediate, boost to the top line and the bottom line for a lot of the companies in this index. It's also things like exporting liquefied natural gas out to Europe to kind of support them as they, kind of try to deal with the threat of Russian gas either being turned off or being sanctioned away, even possibly, right? So very relevant index. This, the Nasdaq Smart Oil and Gas Index is part of a smart sector suite of indexes launched several years ago with our partner First Trust, which has ETFs tracking it. It's a factor-weighted approach. So basically, we look at, in this case, in the case of oil and gas, the top 50 securities in terms of traded value, volume of trading going on in the last 3 months at each reconstitution. Those 50 names are then scored in terms of their value, growth, and volatility, right? So if you have favorable value characteristics, you're cheap on a cash flow to price basis. You've also got high growth metrics as indicated by your price returns over 3, 6, and 9 and 12-month trailing periods. And you've got lower volatility. You score highly on all those, that's going to land you at a nice weighting in this index. We cap the top 5 at 8%. We cap the rest at 4% each and have a minimum weighting of 0.25%. You can see the result here in terms of the top 10 versus the rest of the index. It's about 50-50 split. So a fairly decent level of concentration. And then when you look at the breakdown of the top 10 names, some really well-known names in there, names like Chevron and ConocoPhillips that you'll see on gas stations. Other names here are players in the gas space, the midstream, the pipeline space as well. So a nice mix of kind of producers, refiners, and other types of oil names, which we'll get into a little bit on the next slide.
Right. And Mark, let's take a look at that. What are some of the subsectors that make up the index? And of course, let's also take a look at market cap.
Yeah, so on the left, you can see this split, in terms of subsector. You've got oil, crude producers. Those are by far the biggest chunk here, almost 50% of the index weighting as of this morning. Then you've also got pipeline operators at about 28%, really much smaller allocations to things like refiners, equipment and services, and then the integrated oil and gas names, the ones that are doing kind of a little bit of everything at each stage of the supply chain. And then on the right, you can see the market cap breakdown, not really dominated by the mega cap names here. Again, because this is factor weighted. If you end up scoring well on value, on growth, and on volatility, and you're a mid-cap company, or you're maybe one of the smaller large caps, you can get that 8% capped weighting here. So we're showing that 10 to 50 billion market dollar range. 10 to 50 billion dollar market cap range is the biggest chunk here, almost 50% of the index weight. The next biggest, at about a third of the index, is the sub 10 billion. So really much more of a mid cap and then a small or large cap type of composition here with this index.
And if we take a look at the next slide here, we can see performance, and it gets just a little bit of that opening back up performance as well. I mean, you could see the disparity between the indexes.
Yeah, I mean, this is from November 6th, 2020. So pretty much right around the election, right after when the first vaccine news started coming out from Pfizer and Moderna. That's when the reopening, the cyclical, the reflation trade really got going. And you can see this index is up something like 150% in price return basis since then, quite a bit more on a total return basis, really just blowing away anything that you're seeing in terms of other broad market-based benchmarks in the US. Things like the Nasdaq 100 and the S&P 500, maybe not a surprise, but even things like the Russell 2000, the Russell Value Index, they're in light green, really just blowing away any other kind of attempt to play from a multi-sector basis what's going on in the equity markets. On the right-hand side, you can see those top 10 names that I outlined earlier. Just look at the reversal in returns, 2020 versus 2021. Pretty much every single name flipping over from pretty strongly negative to extremely strong positive performance in 2021. And that's continued year to date. This index is up just about 16%, at least as of Friday's close.
And finally, Mark, where can investors get exposure to the index?
So there's one product tracking this in the US, again, from First Trust, ticker is FTXN. You can see that the AUM on this product was pretty flatlined since it was launched in late 2016. And then we got a big spike in AUM in December of last year. A lot of that was mechanical due to the fact that the Focus 5 index, another Nasdaq product that looks at sector ETFs from First Trust based on their momentum strength. So you're actually kind of getting a boost from the momentum in these names as well. That ETF added, one of its 5 exposures to this index. That's the first time that's happened. There's some indication that some other kind of model portfolios from the Dorsey Wright platform have been also adding this ETF in pretty large quantities starting in December. So we're already up to over 1.2 billion in AUM from just under 60 million a couple months ago. A big chunk of that, again, is those flows in December. Another big chunk is just the really positive performance since then. It continues to go up. It will continue to go up as long as we face these geopolitical tensions and that upward pressure on oil and on gas.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.